So you want to be an options trader. Well, if you want to be an options trader, then you need to learn how the options chain works. The options chain is one of the most important factors to read in order to be successful in this game. It is a lot riskier to be an options trader than it is a stock trader because there's so much more that goes into the calculation of options. And the worst part about them is they expire and can go worthless. But on the other side, you can be very, very profitable and you can make a ton of money if you know what you're doing. And let's start here. This is a stock chart right now called NFLX. NFLX, this example is going to be some pretty high risk, high reward scenario situations here. So this stock got decimated from 700 to 162. You know, it's getting destroyed from their recent earnings reports and everybody was piling into it. And then, you know, a lot came and happened, negative news, they were missing earnings, whatever it may be. And now they're rallying up to 332. So buyers down here are super happy, buyers up here really pissed off. So, we are sitting around 332. It's kind of looking a little bit more overextended to me. As a professional trader, I would consider myself a professional coming from the NYSE and doing this on my own for almost 3 years now, trading my own personal money after quitting on the floor of Wall Street. So as a professional, I'm analyzing the chart first before I get involved in the options chain. So I'm looking at the weekly chart here. It looks like we're seeing a nice little rally, have a nice little top here around this 200 EMA. I would even say that it's probably better to draw it right around here, because there is a support, and resistance point here. 2 support lines, 3 support lines, bouncing. So it could be right around this level, which is exactly what we're testing right here at that 335-ish level. Then I'm going to zoom in on my daily chart. I'm going to look at those levels. Look, it rejected here. And as somebody that doesn't use too many indicators, a lot of people like to use a ton of indicators, but I don't. I use the 200 EMA, which is this green line. The Bollinger Bands, the top one is the red. The bottom Bollinger Band is the green down here. And that's really all I use. I like to use the VWAP as well. But RSI down here, TTM squeeze, these are some kind of useless indicators that I don't really pay attention to too much. Sometimes the RSI when it's really overbought, and then the volume sticks down here are super important. But I really like to look at price action. So as a technical trader, I'm looking at this and I'm seeing, as you notice, Bollinger Bands, they like to stay within this range, getting rejected at the top, getting rejected at the top, same here, does not like to stay above this unless it's being short squeezed. Same on the bottom, it likes to bounce. I'm a reversal trader, love to take these reversals on the Bollinger Bands. So volume and price action and news all obviously take into account there, but as of right now, it looks like it's hitting out to this top line and RSI is overbought to me. So I'm looking at the chart, I'm analyzing, I'm like, oh, this might have some opportunity with earnings coming up. Earnings are the riskiest time to trade, so I don't recommend that unless you know exactly what you're doing and you have a risk to reward ratio and you have an entry and exit point when you are comfortable making or losing money. So let's get right into the options chain from this. So stock chart looks good to me, maybe downside. I'm liking the downside. Let's look at the trade. Trade tab on Thinkorswim pulls us right into the options chain. So you're going to pull up whatever one you want. I already have NFLX here in the search bar. Now we're looking at the options chain down here. There are a ton of dates. There's January 20th. So that's 4 days till expiration, 11 days till expiration, 18 days, all the way down to 732. 732 days till expiration would be something called a leap, which is a long-term expiration. Leap is just the acronym for it. Swing trading is when you buy an option contract and you swing it and hold it overnight. And then a day trade is when you're buying and selling it the same day. So options trading is pretty crazy because there's so many different things in there, like the Greeks that we'll get into. There's something called implied volatility percentage that we'll get into. There's the difference between the bid and the ask spread, which we'll get into on the options chain. And then you just need to know which side you're playing. So in terms of earnings, this is a lot different. I'm going to be swing trading something into earnings. I don't know if I'm going to do it yet, but we're going to analyze it together. So NFLX, I'm looking at this trade on the chart. It looks pretty great to me for the downside. So biased is to the downside. I'd have to read into their 10K reports. I'd have to read into their financials. That's boring stuff. That's not tailored to reading the options chain. So let's get right into it. I'm probably not going to swing something that's the same day expiration. This is the options chain. It looks a little crazy. Don't be too afraid. It's going to be easy once we walk through it. January 4th, I don't like that because the closer, keep in mind, the closer to the options expiration, there's something called theta. Now, this is one of the Greeks that's on the options chain. Theta is going to be the reason that the option loses value as you hold it overnight. So if you think about it like an ice cube, when you take it out of the freezer, it's really intact and secure as soon as you bring it out of the freezer. But as it gets closer to its core, it melts a lot faster. Similarly to the option contract, it is going to get, it's strong when it has a lot of time, but as it gets closer to its expiration date, they start to melt and lose value like the ice cube melts. So that's the analogy I like to use because they are very, very similar in how fast they can melt or deteriorate. So I don't like to do closer to the money, or not closer to the money, closer to expiration until, unless I'm doing a day trade, because it just doesn't make any sense. If there's only 3 days left, then you're just going to get shredded and you're probably going to lose like 30% of your trade just by holding it overnight. It doesn't really make a lot of sense. There's a ton of risk involved there. So the further out you go, the more expensive the contracts are going to be, but the safer you're going to be because you're buying that time and it's a lot more intact because closer to the monies or closer to the expiration are melting like crazy. So let's get right into it. January 27th, I'm going to do the 11 days till expiration. There is a lot of information here. So let's start with the colors. The purple meaning in the money. So in the money means that the contract value or the strike price, which is 330. So if you look at the stock price here, it's 332. So the strike price is what an option contract is. You're betting on the stock to get to a certain strike price by a certain time. So if I'm betting that it's going to be below 330, then it has to be in the money, which would be in the purple over here. So right side is puts, left side is calls. So the strike is where you're betting on the stock price to be. So 330, it's at 332. So technically, if you were buying calls, you are in the money. Call side meaning up, put side meaning down. So the left side is all calls, the right side is all puts. So there's an expiration date here, so you can see the expiration date, all the strikes all the way up from 100 to whatever it is all the way at the bottom. These are 490. I never really go all the way out here. It's more so in the money or a realistic move out of the money. So out of the money is where it's outside of that strike price. So on the call side, it's not yet at 340 here, so they're black because it is out of the money and blue is in the money. Inversely to the put side, if it is out of the money, it's in black on the downside because you're betting on it to go down, and on the upside, these will be making money if the stock falls. These will be making money if the stock goes up. So you're betting on either side here. So out of the money is where the stock has yet to go, and in the money is where the stock already is. So you can see it's within this 330 on the call side, so it's purple, and it's below 335 because it's currently at 332.82. So the put side is purple. So now that we've established the strike and the expirations, let's go over the bid and the ask. So the bid is the price where the highest willing buyer is willing to go, which is at, let's say you wanted to buy this $340, which is $1,500. Keep in mind these are expensive because they're next week's, and they're expensive because it's an earnings play. I won't be buying that close to the money on an earnings play because I like to keep that risk-reward ratio, but we'll talk about that in a second. But for the sake of the video, the bid right here is $1,500. So the least amount you could buy it for is $1,500. You could always put in a different order, like say I only want to buy it at $1,400. I could put in that limit order, but if nobody buys it, then I'm not going to get filled and then it's going to cancel. You could get in a lot earlier if you wanted to buy, $1,525. If you want to get in and get involved and not have to worry about it, you can pay a little extra to get in. And the ask is $1,595. So that is the lowest price that a seller is willing to sell it to. So at $1,595, if you bought it at $1,525 and you wanted to sell it right away, you would only be able to maximum sell it for $1,595. So that is the bid-ask spread, what the willing buyer is willing to buy at and the willing seller is willing to sell at. So it's obviously going to move crazy throughout the day, and you can kind of calculate how much you would make. So literally a $7 move would make you $375, which is very possible in Netflix because if we go back, this is the daily chart. In one day, this stock moved from 311 all the way up to 328. So even like a $17 move on the options chain, you can kind of calculate how much that would be. A roughly $20 move would go from, $20 would be about $1,500. Let's do the 220s or 320s. So these would make about $1,000 a piece on a $20 move. So there's a lot of opportunity here because, 1,000 from 1,500, you could make I mean, that's a great percent return right there. That is well over 50%. You can make 75% on your trade literally off of one day if it's in your favor. So there's a lot of analysis that goes into it. There's a lot of risk involved. But that is the bid ask. That's the willing buyer price, the willing seller price for the bid ask. There is something called implied volatility percentage. So the implied volatility percentage is what they are expecting the stock to move on the options chain. In this case, they're expecting the stock to move 80% implied move. And if you really want to kind of calculate how that actually is, you can actually take a calculator and add the mean or the average between the bid and the ask. So let's just say, for example, it's going to be 1775, the price in between this 1810 and 1755. I'll do 1880 for now. So you do 1880 on the bid side, and then over here on the ask side, you kind of take the middle of the bid ask on the put. So 19.15 plus 19.6. We'll say that's around, I don't know, 1930-ish. So we'll do 1930 plus 1810 gives you 3810. So 3810. Then you just divide it by the actual price of the contract. So 330, we'll say 3, which is not contract, the stock price. So 333 is 0.11. So they are expecting this price to move 11%. We'll multiply that by 100. 11.44% roughly they're expecting the stock to move after earnings. So they're expecting the stock to move 11%. That means that the stock has to move over 11% after this report comes out on Wednesday to make you any money, or they will shred the contracts. They will completely shred the contracts and you will lose money both ways. Doesn't matter which side you're on. Even if the stock moves 5% down, you're not making any money because that implied move, IV percentage, is important. Anything below 80%, I usually say is a pretty good take for earnings. Usually this is not always just for earnings. You can trade without earnings, whatever. You can take swing trades. You obviously want the IV percent lower than possible. Like I said, this is going to be a pretty extreme example because there are earnings this week. So if you can read a very tough options chain chart, then you're going to be able to read something very simple. So 80%, they're expecting the stock to move 11%. So if we go back to the chart, 11% would probably be about $30. And that sounds like a lot, but for a $330 stock, that's not that crazy. Because some of these days, like Netflix went from 280 all the way up to 308 here, 310. So that was well over a 10% move. That was probably like a 13% move day. Sometimes the stock completely gaps down. Look at this, way back in the day. This was another earnings report. This was actually at 332 where it's at right now. And it actually fell all the way down to 214. So this thing fell $115 in one single day. Puts, I was a part of that. That made a ton of money. Thousands of percent return. Crazy. It was ridiculous. So 1,000% return because it went outside that implied move. It dropped, and it ended up dropping, what was that, like 30% when the implied move was like 10%. That's how you make your money in options, when it moves more than it's expected. So the implied volatility percentage, you have to basically price in to see if it's possible. And like I said, that 80% move is right around where you want to, make sure it's below anything like the meme stocks or like 120, 140, 150%. You don't want to be involved in those whatsoever. Headed back to the options chain, you can put whatever you want on these by going to settings, but I like the most important ones are implied volatility, theta, bid and ask, and then obviously the strike. Last one is theta. Been talking about theta since the beginning of this video, and basically all you're going to see here is these little negatives, right? So if I wanted to take this 340, this is negative 87. So what that means is that I'm going to be losing. Make sure that you're multiplying it by 100 because remember, option contracts are 100 shares wrapped up into one contract based off the stock price. So this right here is 0.87, negative 0.87. So make sure that you times that by 100. Same thing with the bid. $15 is actually 1,500. So that means by holding this overnight, this is where theta gets crazy, you're losing $87 every single night you hold this in theta decay. So that is where theta comes in, and it's kind of a bitch for option buyers. Option sellers, this is your best friend. Option buyers, this is your worst enemy. So as it gets closer to expiration, you're losing $87 per contract. So 87 minus 1,500 is obviously 1413. I believe that math is correct. So Just by holding this, you're losing $87. But keep in mind, say it goes up $10 a contract here, then you're finally in the money, so you'll be up 300 minus that 87 if it opens up an extra $10 the next day. So theta decay, you always have to price in what you're going to be losing by holding it overnight. That's why people like to day trade, because they don't factor in theta as much, because you're just buying and selling same day, short periods of time. But by swing trading, you obviously have to keep that into account. So that's where charting comes into play. So if I think it's at the top of the Bollinger Band, earnings are coming up, and I think that, they're not bringing in as much revenue, I think that they're going to miss their expectations, then this big drop down, maybe 20%, could be a big payday. So when I look at this, I might take some far out of the monies. I usually only take far out of the monies because I don't want to risk a ton on theta or on earnings because of theta, because of IV percentage. The contracts could get shredded anyway. So by Wednesday, these could be worth about $450 after theta gets to them. Theta is obviously less the further out of the money you go because it's less likely to get there. So they're implying that this move is going to move 10%. If it goes the opposite way, these contracts will be destroyed. Usually I like to buy contracts anywhere from like 150 to like 400-ish for earnings, depending on how good of a week I had. So when I'm looking at this, I think that 10% could potentially happen, as you already saw, 330 all the way down to 211. So I'm looking at this $300 strike price right here on the options chain, and I'm noticing they're about 585. So if it drops below this, these in the monies will go up to about 1900. So that's about a $1,400 return for a $500 risk. So the risk to reward ratio is about 1 to 3 there. And I usually like to take like a 1 to 5 ratio. So if these are worth 400, 300 by Wednesday with theta decay, and maybe the stock continues to go up for a little bit and they get cheaper, then I might end up taking that. $500 is quite a bit for options earnings play. That might be a little bit outside of my range, but you can tell by subtracting these how much you could potentially be making. So about $500 to $1,800 would be about $1,300 to $1,400 profit, less theta and less the IV percentage. So I think that this might be kind of in the middle for me when I analyze this options chain. I'm not sure if I'm going to take it. I think I might throw a little bit at it. 10% is a pretty big move. On the downside, maybe they drop like 15 to 20%. You end up making about $1,000 a contract. That would be huge. But even then, that's only about 200%. And I know that sounds like a lot, but for as risky as earnings plays are, earnings options trading is, 200% doesn't really sound like a pretty good risk to reward ratio. There's a lot of these out here like Melly or Meta or Apple or Amazon. If they move a certain amount, you can end up making like 700 to 1,000%. Those are the times I like to risk a good amount of money on the trading. So this is real time me analyzing if I want to get involved in these earnings plays or not. Obviously, options trading, these aren't all earnings plays. I don't play them very often, to be honest, but I just wanted to talk about the options chain in an earnings setting because this is the hardest options chain to read. So by talking through implied volatility percentage, the theta, the bid, the ask, the strike, the expirations, I just wanted to talk through it and kind of educate on what it looks like on the Thinkorswim platform or what they mean. It is a lot, so I understand if you have any questions, please leave them in the comments. I think by the end of this, I'm probably not going to go with this. If I do, I might do like a pretty crazy, way out of the money, $250 fill here for $280. That would be a pretty massive move, and at that point, $250 would be worth about $1,400-1,500. That, on the other hand, might be a pretty good risk to reward ratio for me. So for this 310% move in the stock dropping, it just seems like 200% potential is not really worth it to be putting $500 at risk. Even as an expert that's been doing this for a long time, I still don't see a pretty high risk to reward ratio there. So this is the options chain: bid, ask, theta, implied volatility percentage, and the strike/expiration date are the most important pieces. You can add things like the delta on here. You can add different types of like other categories, but these are the main 4 that I watch because these are the main 4 that are the most important. So a lot of information, pretty long video, but tons of value. If you don't pick up on any topics, hit the comments and I will be sure to respond to clarify anything that you are missing. So good luck. Let me know if you need anything. And as always, I'm here to help.